All right. Ready to dive deep into share capital and debentures.
Let's do it.
We've got this chapter from an Indian company law textbook.
Yeah,
It looks pretty dense.
it is a bit, yeah.
But don't worry, we're going to break it all down. It's
Yeah.
Chapter 4 of the Companies Act, 2013,
Right.
and also the Company's Share Capital and Debentures Rules from 2014.
So this deep dive should give everyone a good understanding of how companies in India raise money.
And what rules they got to follow. Perfect.
Yeah.
Let's start with share capital. Now, if you buy a share in a company, what are you actually getting?
You're getting a piece of the company, a piece of the ownership.
Okay.
It's not just about the money you pay for the share.
Right.
It's about having a stake in the company. You're kind of betting on their future, on their performance.
The textbook uses this phrase, not a sum of money, but an interest measured by money.
I like that.
It's about more than just the face value. Right?
Yeah, exactly.
Yeah.
You're buying into the potential of the company. Now, you might hear people use the word stock. That's just a bunch of those shares.
Okay.
Fully paid up shares all bundled together.
Okay, so individual pieces versus a bundle. Got it.
Yeah. And you usually see stock used when people are buying and selling on the market.
Makes sense. Now, within share capital, we've got these two main types, right?
Right.
We've got equity shares and preference shares.
Yep.
So what's the difference?
Well, it's kind of like choosing between two different ways to invest.
Okay.
Think of equity share capital as for those who like a bit more risk.
Okay, the risk takers.
Yeah, they believe in the company. They see the potential for growth.
Mm-hmm.
But they're also the ones who feel it the most if the company doesn't do well.
If it takes a hit.
Yeah, exactly.
And they get to have a say in how the company's run, right?
That's right. That's right. Equity shareholders, they get voting rights.
Okay.
They get to vote on the big decisions.
Got it.
But it gets even more interesting because companies can actually issue equity shares that have like different levels of voting power.
Okay.
And they can even pay out different amounts of dividends.
So not all equity shares are created equal.
Exactly. And that's called differential rights.
Interesting. So some might have more say, and some might get a bigger piece of the profits.
Yep, exactly. It lets companies be flexible.
Right, so they can attract different kinds of investors.
Exactly.
That makes sense.
And here's something I bet you didn't know.
Okay, hit me.
Indian companies can be set up with only equity share capital,
Oh, okay.
but they cannot have only separate share capital.
Oh, interesting. So you got to have some equity in the mix. All right, so what's the deal with preference shares then?
Well, the name kind of gives it away.
They get preferential treatment.
They do, they do.
Uh,
So think of preference share capital as more for those who want a steady income. They're
sure.
looking for less risk.
Steady earners.
Yeah, yeah. And they're the first in line to get those dividends. And if the company winds up, shuts down, they get their capital back, their money back,
Yeah.
before the equity shareholders.
Oh, so they get priority when it comes to payouts.
Exactly, precisely. And there are some big companies in India that have issued these kinds of shares, like InSwift Pharma Labs Limited.
Okay.
They've got preference shares. Panacea Biotech Limited. They've got them too.
Okay.
But here's the thing. With InSwift Pharma, you get a fixed amount of dividend,
Okay.
like a set amount. But with Panacea Biotech, your dividend is a percentage of what the share is worth.
Oh, interesting. Okay, so steady returns, but maybe not as much potential for those huge gains that you might get with equity.
Right, exactly. But here's the important thing.
Okay.
Even though they're seen as kind of passive investors, preference shareholders, they do have voting rights,
Okay.
but only in certain situations.
Like when?
Well, for example, if the company hasn't paid dividends for 2 years or more, then they get to vote on everything.
Wow. Okay, so they have some power there.
Yeah, they can protect their interest if things go south.
Makes sense. Makes sense. Now, let's say you buy some shares. How do you prove that you own them?
That's where those share certificates come in.
Okay.
Your official proof that you're an owner.
Like a deed for your piece of the company.
Exactly. And to prevent fraud, they've got these security features, like signatures from directors, for example.
Oh,
They
okay.
used to have this fancy company seal on them, too.
Right.
But that's optional now,
Since when?
since 2015, actually.
Oh, no more fancy seals.
Oh.
Interesting. What happens if you lose your share certificate?
You can apply for a duplicate,
Okay.
but there's a whole process you got to go through, to make sure everything's above board.
Makes sense.
Yeah.
Now, you don't always have to pay for the shares all at once, right?
That's right. That's right. When you buy shares that aren't fully paid up,
Mm-hmm.
the company can ask for payments on the rest.
Okay.
It's called calls on shares.
calls on shares. So they like call you up and say, hey, time to pay up.
Yeah, that's the general idea.
Okay.
But importantly, these calls, they have to be the same for all the shares of the same kind.
Oh, yeah.
We see this in the case of Prism Glass Limited. They had these different share series with different amounts paid up, and they were treated as separate classes of shares.
So even with shares that have the same face value, how much you've already paid can affect their classification. Okay, that's an important detail. We talked about voting rights and how they're different between equity and preference shareholders.
Right. And even within equity shares, the voting power can be different.
Really?
Yeah, companies can issue shares with different levels of voting rights attached.
Oh, so it's not always just one share equals one vote?
Not necessarily, no. For instance, in Swift Pharma Labs Limited, their equity shareholders, they have 4 times the voting power of their preference shareholders.
Wow, that's a big difference.
It is.
Yeah.
So yeah, you really got to look into the specifics of the shares you're buying.
That's important. What happens if you want to sell your shares or you want to give them to someone else?
That's called transferring or transmitting shares.
Okay.
So if you're transferring them, there's a process. You need documentation. You got to register with the company.
Sounds bureaucratic.
Yeah, a little bit. But it's all about making sure everything's done the right way.
Okay, I get it.
Now, here's a key difference.
Okay.
Shares of public companies, they're generally freely transferable.
Okay.
But private companies, they often have restrictions.
So if I own shares in a private company, I can't necessarily just sell them to anyone I want.
Yeah, that's often the case. They might have rules. Maybe you have to offer them to existing shareholders first.
Okay.
Or other conditions you got to meet.
Interesting. So the type of company really impacts your flexibility. Now, what about those partly paid shares?
Right.
Are there any special rules for transferring those?
Yeah, there's an extra layer of protection for whoever's getting those shares.
Okay.
The company has to tell them about the transfer.
Okay.
And they have 2 weeks to object.
Oh, okay. So they can't be stuck with a partly paid share.
Exactly.
That's knowing about it.
Transparency is key. Now let's switch gears a bit. Let's talk about some interesting situations when companies issue shares.
Okay.
Like issuing shares at a premium.
Okay.
The whole discount dilemma.
All right.
And this thing called sweat equity.
Okay, lots to unpack there. So issuing at a premium, that sounds like when a company's doing really well.
Yeah, you got it.
And people are like clamoring to buy their shares.
So the demand is high, yeah.
Yeah.
Companies can issue shares for more than their face value.
Okay.
That extra amount, that's the premium.
So the company gets a little extra cash?
Well, not exactly.
Oh.
It goes into a special account.
What's it called?
It's called the Securities Premium Account.
Securities Premium Account. Okay.
And there are rules about how they can use that money.
So they can't just go on a spending spree?
Nope. It can be used for specific things, like issuing bonus shares or covering the costs of issuing those shares.
Makes sense.
Or even buying back shares from the market, which we'll talk about later.
All right, so there are safeguards in place. Now, what about this discount dilemma?
Yeah.
Does that mean companies can issue shares for less than their face value?
Well, generally, no.
Okay.
It's prohibited.
So no bargain basement shares?
Not usually, but there are a few exceptions.
Okay.
One big one is for sweat equity shares.
Okay.
These are shares that are issued to directors and employees.
Okay.
To reward them for their contributions to the company.
Sweat equity. So shares you earn by working hard, using your expertise.
Yeah, exactly.
Not just by paying money.
It's a way to reward the people who are really invested in the company's success.
Okay.
Those contributing their know-how, their intellectual property, that kind of thing.
I like that. It recognizes the value beyond just the money. And these sweat equity shares can be issued at a discount.
Yes, they can. But there are conditions, of course.
What kind of conditions?
Well, they got to get authorization, make sure the valuation is fair.
Okay.
And often there's a lock-in period where those shares can't be sold right away.
Right, so safeguards to prevent misuse?
Right, exactly.
Besides sweat equity, are there any other times a company can issue shares at a discount?
Yeah, actually. There was a change back in 2017 that allows for discounts when shares are issued to creditors as part of debt restructuring.
Oh, interesting. So there are a few specific situations where it's allowed.
Yep, that's right.
Okay. Now let's explore what companies can do with their share capital after it's been issued.
Okay, sounds good.
We're talking about bonus issues, reduction of share capital, and buybacks.
All right, let's break those down.
Okay, first up, bonus shares. What are those all about?
Well, you can think of bonus shares as a way for the company to kind of share their success with their shareholders.
Okay.
It's like getting a bigger piece of the pie without having to pay anything extra.
Sounds like a pretty sweet deal. How do they decide how many bonus shares to get out?
It's a strategic decision. They got to look at their financials, their goals, how much they have in reserves, what the impact might be on the share price.
So it's not just a random giveaway.
No, not at all.
There's a lot of thought that goes into it.
Absolutely. There are rules in the Companies Act about this.
Okay.
Bonus shares, they got to be fully paid up.
Right.
No handing out partially paid shares as bonuses.
No shortcuts.
And the funds to issue those bonus shares, they got to come from specific sources.
Okay, so where do they come from?
They can use their free reserves.
Okay.
They can use the securities premium account.
Okay.
Or the capital redemption reserve account.
Okay. And just remind me, what was that capital redemption reserve account again?
Oh, right. Yeah. That's a reserve that sometimes companies got to set up when they buy back their own shares.
Oh, okay.
It's kind of like a safety net.
Okay.
So they have funds available if they need to, buy back certain types of shares in the future.
Right. That makes sense. So there are safeguards in place to make sure
Yeah.
these bonus issues are legitimate. Now, what about this reduction of share capital?
Yeah.
It kind of sounds like the company's shrinking.
It can seem that way,
Okay.
but often it's a move they make to, kind of clean things up.
Okay.
Optimize their financial structure.
What are some reasons a company would want to reduce their share capital?
Well, sometimes they do it to write off losses.
Okay.
If a company's been hit hard
Yeah.
and they've got these significant losses, they could reduce their share capital, essentially wipe the slate clean,
Okay.
start fresh with a smaller base.
So it's not necessarily a bad thing?
No, not always.
It could be a positive step?
Exactly. Sometimes they had too much capital.
Yeah.
It's just sitting there not being used effectively.
Right.
So they might decide, hey, let's return some of this to the shareholders.
Okay, so it's about restructuring.
Yeah, exactly. Becoming more efficient. And remember that share split we talked about?
Yes.
Where they divide those existing shares into smaller units?
Right, the pizza analogy.
That's it. Cutting the same pizza into more slices.
Exactly.
That can be a way to reduce share capital, too.
Okay, so lots of different ways to approach it.
Yep.
All right, let's move on to buybacks.
Okay.
This is where the company buys back its own shares, right?
That's right. It's like they're going into the market and saying, we believe in ourselves.
We're going to buy our own stock.
Yeah, exactly. They're signaling to the market that they're confident in their future.
So it's a way to show confidence
Yep.
and reward shareholders at the same time.
Precisely. But I'm guessing there are rules about how they can do this.
There's always rules.
Oh, yeah. Lots of rules. The Companies Act, it lays out a pretty clear framework for how to do buybacks the right way.
Okay, so walk me through it.
So first of all, the buyback has to be allowed in the company's own rule book. They call it the Articles of Association.
Okay, so it's got to be part of their governing documents.
Right, exactly. And then they usually need to get approval from their shareholders.
Okay.
Through a special resolution.
So everyone's got to be on board.
Yeah. But there's an exception for small buybacks.
Oh, okay.
Then a board resolution might be enough.
So different levels of approval depending on how much they're buying back. Got it.
Right. There are also limits on how much they can spend on buybacks. They can't use more than 25% of their combined paid-up capital and free reserves.
So there are safeguards in place to protect the company's overall financial health?
Exactly. And before they can even do a buyback, they got to file something called a solvency declaration.
What's that?
It's a statement basically saying, hey, we're in good shape financially.
We can meet our obligations.
Even after spending money on buying back shares.
So it's like a financial checkup.
Yeah, exactly, to make sure they're in good shape to do this.
Yeah.
And once they've got the green light, they got to complete the buyback within a certain time.
Okay.
Usually within 12 months.
So it's a structured process.
Right.
With deadlines, no dragging it out indefinitely.
Exactly. Now, how do they actually buy back those shares?
That's a good question.
There's a few ways. One way is they can offer to buy back shares from existing shareholders proportionally.
Oh, okay. So everyone gets a fair chance.
Yeah. Everyone can sell a certain percentage back to the company.
Huh.
Another option is buying shares from the open market through those stock exchanges.
So they're like competing with other buyers?
Yeah, to repurchase their own shares.
Yeah.
And then lastly, they can buy back shares that were originally issued to employees. Things like stock options or sweat equity plans.
Right, so it's a way to provide an exit for employees who were given shares as part of their compensation. That makes sense. Now, what happens after the buyback's done?
Well, Those repurchased shares, they just disappear.
They vanish.
They're canceled.
Okay.
They no longer exist. And they have to file a return of buyback with the registrar of companies to detail the whole transaction.
So full transparency, a paper trail.
Absolutely. Got to have it.
Now, there's this thing called a cooling period. What's that? Like, do they need to take a break?
It means after a buyback, the company can't issue new shares of that same kind for 6 months.
Oh, so they can't just buy back a bunch of shares and then immediately issue more.
That's right. That's right. It's to prevent manipulation.
Makes sense.
You know, they got to show that they're doing this to benefit the shareholders.
Not just as a tactic.
Exactly.
Okay, that makes sense. So there are a lot of rules, but they seem like a powerful tool for companies.
They are. They are.
To manage their capital, reward their shareholders, and signal that confidence.
Absolutely. It's fascinating stuff. It is. Now, we've covered a lot of ground on share capital. Let's shift our focus back to debentures.
Okay, let's do it.
So we know they're basically loans that companies take from the public, but are there different kinds?
Yeah, are there?
There are. One way to think about it is whether they are secured or unsecured.
Secured debentures, those sound like they're safer for the lender.
They are. They are. So with a secured debenture, the company pledges some assets as collateral.
Okay, like what kind of assets?
Oh, could be property, machinery, that kind of thing.
Okay, so if the company can't repay the loan, the debenture holders, they can claim those assets.
Exactly.
It's like a safety net.
It is. And unsecured debentures, they don't have that backing.
So it's riskier.
It is, yeah. Lending to a company through an unsecured debenture, it's riskier.
Makes sense. So unsecured debentures, they probably offer a higher interest rate then.
Often, yeah, to compensate for that extra risk.
Wow.
Makes sense, right?
Yeah, it does. What other kinds of debentures are there?
Well, you've got convertible and non-convertible debentures.
Okay.
So a convertible debenture, it gives the holder the option to change it.
Into what?
Into equity shares of the company.
Oh, interesting. So you could start as a lender and then become a shareholder.
Exactly. It's all about flexibility, you know, and you'd have that chance to profit if the company does really well.
Right. Okay, so what's a non-convertible debenture?
Well, that one just stays a debt instrument.
Until?
Until it matures.
Okay, so it's a choice between those steady interest payments or the potential for bigger returns through equity?
That's right.
Okay, got it. Anything else?
You've also got redeemable and irredeemable debentures.
All right.
So a redeemable debenture, it has a fixed maturity date.
Okay.
That's when they get the principal back.
Right, their initial investment.
Yep. And an irredeemable debenture, well, it doesn't have a fixed maturity date.
Oh, so they just keep going.
You could think of it that way. It continues indefinitely.
Wow.
And the company just has to keep paying the interest.
Okay, so there's quite a variety when it comes to debentures.
There is. There is.
Each with its own level of risk and reward.
Exactly. Companies, they can tailor these offerings to attract different investors.
Right, so it depends on their needs.
Exactly.
Okay. We talked before about the debenture redemption reserve, which is a reserve that companies have to set aside when they issue debentures. Why is that?
It's all about making sure that when it's time to pay those debentures back, they've got the money.
It's like a savings account.
Yeah, you can think of it that way.
Specifically for repaying the debentures.
Exactly. The Companies Act sets rules for how much they got to transfer to this reserve each year.
Okay.
So, for example, listed companies, they generally need to set aside 15% of the value of the debentures that are due to mature in the following year.
Okay. And where does that money go?
Well, they can deposit it with a scheduled bank.
Okay.
They can invest it in government securities, or they can invest it in certain other approved securities.
So safe options.
Safe and secure, yep.
To make sure the money's there when it's needed.
Exactly. And that amount they've invested or deposited, it can never fall below 15% of those maturing debentures.
Oh, okay. So there's this ongoing responsibility.
Yeah, they got to maintain that reserve.
Okay.
It's all about protecting the debenture holders.
Makes sense. Now let's talk more about this debenture trustee.
Okay.
What do they do?
They're there to protect the interests of the debenture holders.
Okay.
So they make sure the company's following all the rules.
Okay.
You know, fulfilling its obligations under the agreement.
Right.
Like paying the interest on time, redeeming those debentures when they mature.
So they're like, oh, watchdog.
That's a good way to put it.
Looking out for the lenders.
Yep. They also make sure that any assets that have been pledged as security, that those are being properly maintained.
Okay.
And if the company, you know, if they default on their obligations, the debenture trustee, they can take legal action to protect the debenture holder's rights.
So they have some real authority.
They do.
Okay, that's good to know. Now, is there anything that protects the debenture trustee, if something goes wrong?
Yeah, the Companies Act, it does provide some protection.
Okay.
But there's a key condition.
What's it?
The debenture holders themselves, they have to agree to those exemptions.
Oh, interesting.
Yeah, so it's a democratic process.
So the debenture holders, they get to decide how much risk the debenture trustee should be exposed to.
Exactly. It all comes down to transparency and accountability.
Makes sense. Wow, we've covered a lot of ground today.
We have.
From the basics of share capital and debentures to the strategic moves that companies can make.
It's fascinating stuff.
It is.
And we've only just scratched the surface.
I know, right?
There's so much more to learn.
But for now, let's take a breath.
Yeah, let's give everyone a chance to process all this information.
In the final part of our deep dive, we'll bring it all together with some real-world scenarios and examples.
Yeah, that'll be great.
That way you can see how all this plays out in practice.
Sounds good.
Get ready to put your knowledge to the test.
All right. Think of them as like a reward.
Okay.
For the shareholders.
Okay.
You get a bigger slice of the ownership pie.
Without having to pay for it.
Exactly.
Yeah.
That's pretty sweet.
It is.
But how do they decide how many bonus shares to give out?
It's a strategic decision. They got to look at a bunch of factors.
Okay.
Their financials, their strategic goals, how much they have in those reserves.
Right.
What the impact might be on the share price.
Okay, so it's a balancing act.
It is. It is.
It can't just be like overly generous.
No, not at all.
There are limits.
Right. Let's say, for example, a company, let's call them Technova Solutions.
Technova Solutions.
Yeah, they've had an amazing year.
Okay.
Profits are through the roof.
Oh.
So the board says, let's celebrate. Let's issue some bonus shares.
Makes sense. So let's say they have 1 crore rupees in free reserves.
Okay.
And they decide on a bonus issue ratio of 1 to 2.
1 to 2.
Yeah. So for every 2 shares a shareholder owns,
okay,
you get an extra share, a bonus share.
So if I had 100 shares,
yep,
I'd get 50 more.
That's right.
Bringing my total to 150.
Exactly.
Not bad.
Not bad at all. And we know those bonus shares have to be fully paid up.
Right.
And those funds, they got to come from the right place.
Absolutely. No cutting corners.
So free shares.
Yeah.
Everyone's happy, right? Is there a downside?
There are a couple things to keep in mind as a shareholder.
Okay.
When bonus shares are issued, the number of shares out there increases.
Right, of course.
So that can dilute the earnings per share.
Okay, so the same amount of profit is divided among more shares.
Exactly.
So what's the upside for shareholders then?
Well, the bonus shares themselves.
Okay, true.
That's the immediate upside.
You got more shares. Yeah. And even though earnings per share might go down a bit,
right,
having more shares out there, it often makes them more affordable.
Okay.
So you might attract more investors.
Okay.
More trading activity. And that could actually boost the company's overall market value.
All right, so it's a bit of a trade-off.
It is. It's something to think about.
That makes sense. Now, what about a situation where a company needs to reduce its share capital?
Okay, let's imagine another company, let's call them Green Tech Industries.
Green Tech Industries.
They've been hit hard by a tough economy.
Okay.
And they've got some losses.
Some significant losses.
Yeah, some pretty big losses.
Ouch. So what can a company like Green Tech do in that situation?
Well, one option is they could reduce their share capital.
Okay.
It's a way to, to kind of wipe those losses off the books.
Okay.
And they get a fresh start,
So they kind of hit the reset button.
Yeah, exactly.
But I'm guessing there's a formal process.
Oh, yeah, absolutely.
They can't just decide to do this.
No, not at all.
Yeah.
First, they got to get the shareholders to agree to the plan.
So everyone's got to be on board.
Through a special resolution, yeah.
Okay. So the shareholders say, yeah, we're okay with this reduction.
Right.
What happens next?
Then they got to go to the National Company Law Tribunal.
Okay.
And get their confirmation.
So there's judicial oversight.
Yeah. The tribunal, they'll look at the company's financials, make sure it's fair.
Makes sense.
Make sure it doesn't hurt the creditors.
Right. Got to protect everyone.
Absolutely. And then once the tribunal says, go ahead, Green Tech has to update their official documents.
Okay.
And register those changes with the Registrar of Companies.
Okay. So lots of hoops to jump through.
It's a process.
It's not a simple thing. And as a shareholder, it's important to understand that this could affect your ownership.
It could, yeah.
It's not a decision to take lightly.
Right. Now, let's look at a scenario where a company might do a buyback.
Okay, let's do it.
Imagine a company, let's call them Pharmatech Innovations.
Pharmatech Innovation.
They're a pharmaceutical company.
Oh, yeah.
And they've just developed this amazing new drug.
Yeah. Okay.
And it's selling like crazy.
That's what we like to hear.
So now they've got all this extra cash.
Okay.
What should they do?
Good question.
Well, they could do a share buyback.
Okay.
Use some of that profit to buy back their own shares.
What are the benefits of that?
It returns value to the shareholders.
Okay.
And it often boosts the value of the remaining shares.
Okay.
And signals confidence, too.
It's like they're saying, we're doing so well, we believe in ourselves.
Exactly. We're willing to invest in our own shares.
Yeah, I like that. But we know there are rules.
Oh, yeah. Always rules.
They got to get authorization.
Right.
Pass a special resolution.
Yep.
File that solvency declaration.
Yeah, great.
So it's not just a free-for-all.
No. Yeah, got to do it the right way.
Let's say Pharmatech wants to buy back, I don't know, 10% of their shares.
Okay.
From the open market.
Okay.
What happens next?
Well, they would announce it.
Oh,
They'd say, hey, we're going to do a buyback.
We're in the market.
And then they'd start buying shares on those stock exchanges.
Competing with other buyers.
Yeah.
Okay.
And once they've bought back the number of shares they want,
Mm-hmm.
they cancel those shares.
So the total number of shares out there decreases.
Exactly.
Which means the earnings per share go up, and the value of the remaining shares probably goes up too.
Quite possibly.
Yeah. Okay. So it can be a win-win.
It can be.
For the company and the shareholders.
Absolutely.
Wow, these scenarios really bring it all to life.
They do, don't they?
We've gone from like these abstract concepts to seeing how share capital and debentures are used.
In the real world.
In the real world, yeah.
It's fascinating to see how companies use these tools.
It is. It is.
To achieve different goals.
Yeah.
You know, they're the fundamental building blocks of company financing in India.
And we know the Companies Act provides that regulatory framework to make sure everything is done properly.
Transparently, fairly.
It's complex, this area of law.
It is.
But understanding the basics is important for anyone who wants to understand business and investing.
Absolutely.
Yeah.
And if you're curious, you know there's a ton of information out there.
Keep exploring, keep learning.
That's right.
All right, let's take another breath.
Okay.
Let everyone digest this.
Yeah.
In the final part of our deep dive, we'll wrap it all up.
Sound good.
Okay, we've learned so much about share capital and debentures.
We have.
Now let's see how it all works in real life.
Yeah, let's look at some scenarios.
Put on your analyst hats, everyone. All right, hit me with a scenario.
Okay, so imagine a tech company. Let's call them Technova Solutions.
Okay, Technova Solutions.
They've had a fantastic year.
Right.
Profits are way above target.
That's great.
So the board decides, hey, let's give out some bonus shares.
Makes sense. Everyone loves a bonus. But how do they figure out how many to give?
Well, they have to consider a few things, like their financial statements, of course, their goals, you know, what they're trying to achieve, how much they have in those reserves, and also what impact it might have on the share price.
So they can't be too generous?
No, they got to find that balance.
Right.
Let's say Technova has 1 crore rupees in free reserves.
Okay.
And they decide to go with a bonus issue ratio of 1 to 2.
1 to 2. So that means for every 2 shares someone owns, they get 1 extra share as a bonus.
Exactly.
Okay, so if I owned 100 shares, I'd get 50 bonus shares.
That's right, bringing your total to 150.
Not bad.
Not bad at all.
And we know those bonus shares got to be fully paid up.
Right.
The funds have to come from the right sources.
Absolutely. No cutting corners.
So free shares, everyone's happy, right?
Well, there are a couple things to think about. As a shareholder, you know.
Okay, like what?
Well, when a company issues bonus shares, the number of shares out there increases.
Right, more shares.
So that can dilute the earnings per share.
Okay, so that same profit is now spread out over more shares.
Yeah.
What's the benefit for the shareholders then?
Well, the bonus shares, of course.
True, you get more shares.
You get more shares. And even though the earnings per share might go down, having more shares available can make them more affordable.
Right.
You know, attract new investors.
Right.
That can lead to more trading activity.
Uh-huh.
And that could boost the company's market value overall.
Okay, so it's a trade-off.
Yeah, definitely something to consider.
That makes sense. All right, what about a scenario where a company needs to reduce its share capital?
Okay, let's picture a company, we'll call them Green Tech Industries.
Green Tech Industries.
They've been struggling a bit. The economy's been tough on them.
Okay.
And they've racked up some losses.
Significant losses.
Pretty significant, yeah.
Ouch. So what can a company like Green Tech do?
Well, one option is to reduce their share capital.
Okay.
It's a way to, you know, kind of reset things, wipe those losses off their books.
Okay, so like hitting the reset button. But there's a process for this, right?
Right, yeah, absolutely. It's not a decision they can just make lightly.
Of course not.
First, they got to get the shareholders to agree.
Okay, so the shareholders got to be on board.
Yeah. through a special resolution.
So they all vote and say, yeah, we're good with this.
Exactly. And then green tech would have to go to the National Company Law Tribunal.
Okay.
And get their confirmation.
So there's that judicial oversight.
Right. The tribunal looks at everything, make sure it's fair, make sure it doesn't negatively impact the creditors.
Got to protect everyone.
Absolutely. And once the tribunal gives them the go-ahead, then green tech has to update all their official documents.
Yeah, okay.
And register those changes with the registrar of companies.
All right, so it's a multi-step process.
It is.
It involves a lot of approval.
Yep. It's not a simple thing.
And as a shareholder, it's important to understand that this could affect your ownership.
That's right. It's a big decision.
It is. All right, let's look at a buyback scenario.
Sounds good.
Imagine a pharmaceutical company. We'll call them Pharmatech Innovations.
Pharmatech Innovations.
They've developed this groundbreaking new drug.
Okay.
And it's flying off the shelves.
Fantastic.
They're making a ton of profit. What should Pharmatech do with all that cash?
Well, they could do a share buyback.
Okay.
Use some of that profit to buy back their own shares from the market.
What are the advantages of that?
Well, it can return value to the shareholders.
Okay.
And it often boosts the value of the remaining shares.
Okay.
And it also shows confidence in the company.
Like they're saying, we're doing so well, we're going to invest in ourselves.
Exactly. But of course, we know there are rules around buybacks.
Right. Always rules.
Pharmatech would need to get authorization, pass a special resolution,
right,
file that solvency declaration we talked about. So they got to do it by the book.
Absolutely. Let's say Pharmatech decides to buy back, I don't know, 10% of their shares from the open market. What happens then?
Well, first, they would announce their plans.
Okay.
Let everyone know they're doing a buyback.
Okay. We're in the market.
And then they'd start buying those shares on the stock exchanges, competing with other buyers.
Okay.
And once they've bought back the amount they want, those shares are canceled.
So there are fewer shares out there.
Exactly.
So the earnings per share go up.
Go up.
And the value of the remaining shares likely increases too.
That's right.
So everyone wins.
It can be a win-win, yeah.
Wow, these scenarios really show how it all comes together.
They do, don't they?
We've gone from these kind of abstract ideas about share capital and debentures to seeing how companies actually use them.
In the real world, yeah.
In the real world. It's fascinating.
It is.
You know, there's such important tools for companies in India.
They really are. The fundamental building blocks of company financing. And the Companies Act helps make sure everything is done fairly and transparently.
Right, with all those rules and regulations.
Exactly.
This is a pretty complex area of law, but
it can be, yeah.
Understanding the basics is so important.
It is.
For anyone who's interested in business or investing.
Absolutely. And if this deep dive has sparked your curiosity, keep learning.
Yeah, keep exploring. There's so much more to discover.
That's right.
Well, that brings us to the end of our deep dive into share capital and debentures. I hope you learned a lot.
Me too.
It's been a fascinating journey. And remember, this is just the beginning. Keep asking questions, keep learning, and keep diving deep into the world of business and finance. Thanks for joining us.
Thanks, everyone.